Good afternoon and welcome everyone. Welcome to the final session of our AXA Annual Finance and Aged Care Symposium, day one today. My name is Susan Greenbank and I'm the Senior Manager Membership and Partnerships here at AXA, and will be facilitating this session this afternoon. I'd like to thank you for taking time to be part of our online symposium, and we've got a great session coming up over the next hour around home care. I'd like to also take the opportunity to thank our presenters. We'll have two presenters who I'll introduce to you very shortly, and in particular also to thank our sponsors, for without them we would not be able to bring these events to you in such an accessible way. So thanks very much to our principal sponsor for this event, HESTA, and our major sponsor for day one, Russell Kennedy Lawyers. So our session this afternoon is going to be on managing impacts from the new home care funding model. There will be two parts to the session, two presenters, and then we'll have questions at the end of that. So looking forward to introducing them to you shortly, but just a wee little bit of housekeeping to start off with. We would like the session to be as interactive as possible. So if you'd like to submit a question to any of our speakers, please use the Q&A button that's at the bottom of your screen there. And by opening the Q&A, you'll also be able to see other questions that have been submitted. Please also feel free to share any comments into the chat box, which is also at the bottom of your screen. So questions into the Q&A and comments and into the chat. Thanks very much. If you do experience any technical issues throughout the event, please send a message through the chat function and our team behind the scenes will assist you as soon as possible. So without further ado, I'd like to introduce our first speaker for this session, and that is Anita Courtney, who is the Principal Lawyer at Russell Kennedy Lawyers. Anita's going to be taking us through a home care pricing update. And Anita, as a principal in Russell Kennedy's aged care team, has a focus on the home care sector. She specialises in helping home care providers comply with their legal responsibilities under the Aged Care Act and its principles, as well as privacy legislation and other laws. She also assists providers in managing complaints, debt recovery issues, and helps them to understand their duty of care and dignity of risk issues. Anita also helps providers respond to and challenge decisions of the aged care regulators, including the Department of Health and the Aged Care Quality and Safety Commission, and represents aged care providers in guardianship and administration proceedings in Victoria and other states. So welcome, Anita. Thanks for being with us today.
Thank you, Susan, and thanks everyone for joining this afternoon. So I will just start sharing my screen, so give me a moment. Thanks everyone for that patience. A few little technical things always. So as Susan said, I'll be giving you a bit of an update on home care pricing compliance issues. I'm conscious that the session is about the impact of the changes coming in September, in particular around home care funding. And what I'm going to talk about today is really important to that, because I think the more the government holds the purse strings, the more it is important you get your home care pricing basics right. So I'm going to run through those and also talk about some of the things that we've been seeing in terms of these issues over the last couple of years, and particularly the last year. So I'll talk a little bit about pricing schedules and agreements. I'm going to talk to you about some of the requirements of these, why they matter, and also the common mistakes that we see, particularly with pricing schedules, because that's an area where I think the sector is still coming to terms with what the requirements are. I'll also talk about fee variations. So this is where you go to review your prices every year, as you're required to do, as you know, under your pricing schedule. And what are the common mistakes that providers are making there? Because that is an area where we're seeing quite a few providers have compliance difficulties. Then I'm going to talk about quite a popular topic, I think, and it's really this issue of what you can and can't spend home care funds on. And I'll talk particularly about some of the risk areas, and those are what I call everyday items, so things that you or I might purchase, and then a consumer of home care may wish to purchase using their package funds, and some of the risks and difficulties that lie there. And I'll also talk about home modifications and some tips if you are going to allow a consumer to use their package for that. So in terms of compliance trends, what we see in home care is that the number one risk area for providers is around fees and finances. And we see that reflected in the complaints data. So this is the most recent data I could find from last year, but you see lots of the complaints are related to home care fees. And we know that the media, politicians, Rebecca Sharkey, for example, are very focused on what providers are charging and whether they see consumers being quote unquote ripped off. So that is where the focus is in terms of home care compliance. And while occasionally clinical issues do arise in home care, and we have seen providers be sanctioned or have notices of non-compliance for more clinical quality issues, the vast majority of compliance issues are in this space. So it is really important. What we also see is when providers get this wrong, providers are sometimes ordered to refund fees and to refund funds to the home care client's package. So that's why getting this stuff right is really important. So when it comes to pricing schedules, I think it's just worth being clear about why they are important. So home care is a market-based system, we're told. What I mean by that in here is that unlike NDIS, where you have fixed pricing for services, your only basis to charge a client's package a fee is your agreement and your pricing schedule. So you really need to have these things correct and in place from the get-go. Otherwise, you can be at risk for having to refund. So in terms of client agreements, these are the basics when it comes to pricing. You must have your pricing schedule in your client agreement. You have to say what fees you charge. If you charge the basic daily fee and the income tested fee for that client, that has to be in the client's agreement. If a client has a different fee arrangement, you have to mention this in your client agreement and you have to say why. So that might be that they have chosen to get their own gardener and that gardener charges a different rate to what is within your pricing schedule. You must say why it is that the client isn't going to be paying the standard fee. And yes, as I said, if a client is getting off schedule services, so what I'm talking about here is things that you don't put in your pricing schedule. So things like home modifications, again, you have to have an agreed price somewhere. So that might be in the client agreement, or it might be just in some email correspondence you have with the client in which they agree that, yes, I'll pay X amount for that service. You should make sure your client agreement deals with how you will adjust fees, and I'll come to that in more detail later on, but the more you can do that up front, the better it will be and the easier it will be. And finally, I do suggest you have consumer law limitation clauses in your client agreement if you don't already, because the consumer law says that services have to meet a certain standard. And what it says is that if you put it in your agreement, you can say, if we don't meet that standard, then any compensation will be limited to us either resupplying the services or else we will give you the money that those services would have cost. But if you don't have that in there, you're potentially up for more compensation. So it is good to have the Australian consumer law limitation clauses in there. So in terms of what your pricing schedule has to say, what the basics are in your pricing schedule, rather, you have to give it to the pricing department, as you know, so they can put it on My Aged Care, and it must also go in your client agreements, and that includes for the clients who signed up before pricing schedules were a thing. So if you've still got any clients that haven't re-signed, you do want to try and deal with that. It must be reviewed annually as well. There is no prescribed format for a pricing schedule. However, there are certain things it must include. So as you know, it has to include pricing for a list of specified, quote, common services. And I'll run through those. You have to say also if you charge the basic daily fee. If you don't charge it, I think it's okay to say silent on that. However, if you do charge it, it's best to actually say that, what it is. You have to also say whether you charge a fee for engaging third-party suppliers at the client's request and what that fee is. and you have to say a price per kilometre for travel to the consumer for providing services. So we review quite a few pricing schedules to help providers get this right. And these are the common mistakes we see. So a lot of the time providers forget to give prices for certain things. So like gardening, for example, I often see things like contact us for a quote. That doesn't comply. You do have to give a price or a range of prices, even if it's not a service you yourself provide. And not mentioning the basic daily fee, if you do charge it, that's another mistake we see. The other thing is we often see providers using their own terminology. So they might say domestic assistance rather than calling it cleaning and household tasks, which is what the legislation says. Although I've not seen any providers get in trouble for this, so to speak, I do think it's a risk area because the whole idea of pricing schedules is for consumers to compare like for like. So if everyone's using their own terminology, that becomes tricky. So I do think that the Commission is likely to start to crack down on that. Another one we see is that sometimes for providers forget to specify if there's a maximum on how many care management hours, maybe not package management, but you might have a limit on how many care management hours you're providing for that price. And if the client needs more, then you will want to charge an hourly rate above that. You may also have issues with whether charges are, whether your fees are for sort of per hour or part thereof, just being clear about that on the pricing schedule. And here's a big one. Using percentages rather than dollar amounts is a no-no. According to the Department of Health, and there is good sort of basis for them to say this, you must express your prices in dollar amounts. So we can't have the 20% care management fee anymore. And finally, not having a range of prices for third-party services. If you can't guarantee services at that price, you want to put a range in. And then there's finally inaccurate statements about GST, just making sure, perhaps you run that by your accountant. It's good to just be clear about what your position on GST is. These are the things you have to include in your pricing schedule, but I'm going to just skip over them. The slides will be distributed later, so you're more than welcome to go through them. One final thing I'll just say is that there is a bit of a question about your ability to charge for a sort of brokered services fee. So we know that you can charge a fee when you are providing care or services through a subcontracting arrangement that is necessary to give effect to a request by a consumer. However, that does not clarify whether you can also charge it where you just, as a matter of course, outsource services. And I do think if the consumer hasn't actually asked you to outsource, but that's just your business model, that there may be risks with charging a third-party contractor fee. So that's just an area where I think that we may need a bit more clarity from the department or the Commission. The other thing I would say with these sorts of fees is this is where commonly we do see providers using percentages. And I can completely understand that. How on earth can you price for the same fee for, say, outsourcing personal care and then outsourcing home modifications? I think it's quite reasonable to charge as a percentage. And yet the Commission's position is, no, you must still give a dollar amount. I think it's quite difficult. And my suggestion to providers is if you want to use a percentage, then maybe give some examples of how that translates to a dollar amount. It may seem a bit silly if you're charging, say, 10% to say that means on a $200 invoice, you will pay $20. But I think that will hopefully go a little way to meeting the Commission's concerns and position there. All right, so moving on to another sort of key risk area, fee adjustments and increases. So basic rule is you can only increase your fees or introduce new fees with the client's agreement or their consent. And this is the reason why this is a section extracted from the user rights principles. And you'll see the bit I've highlighted there. You can only make a change to your home care agreement, and that will include pricing under that agreement, by mutual consent following adequate consultation. So what we commonly see, unfortunately, is, and it's very, very understandable because I'm not sure how many of you are a member of a gym or your electricity provider. They don't consult with you and get your consent when they want to put their fees up. They tell you this is what's happening, take it or leave it. And that's the approach I think that a lot of the industry have thought is okay in home care. However, because of this provision, it's not actually going to cut it. And we see quite a few providers have issues when they try to implement that sort of approach. So simply writing to a client, for example, and saying, our fees are going up 1 July. It doesn't matter if you give them 6 months or 12 months notice on that, or a month. It's not really enough. You have to actually actively consult with the client and obtain their consent. That doesn't necessarily mean meeting face to face, but it does mean, I think, writing to them and also having a conversation with them and getting them to agree, preferably in writing, but if they give you consent over the phone verbally, that will suffice as well. You just want to make sure that is very, very well documented. So I have heard people say, but what about implied consent? If I tell them my fees are going up and they choose not to leave, then they've impliedly consented. It doesn't work, unfortunately. So I would say that this approach is very, very common, this sort of take it or leave it approach. And certainly no doubt there's a number of providers in the industry who have gotten away with that just fine. But I can tell you that if it comes under the scrutiny of the Commission, it will be an issue for you. And the risk is you then have to either go back, renegotiate to get consent retrospectively, or you have to refund fees. So it's not a good position to be in. So how can you avoid this situation? The first thing is have something in your client agreement. And I did mention that earlier, and this is why. So if you've got a clause in there that says every July we're going to put our fees up by X amount or CPI, then that gives you a ground to say we don't need to get more consent. The client consented when they signed up with us. You do need to be quite specific. I have seen clauses that say things like, we will put up our fees once a year by giving you 28 days notice. Because you haven't said how you'll put your fees up and by how much, that doesn't cut it. It's really not consent in the sense that it's meaningful. A consumer could be agreeing under that clause to a fee increase of 1%, or they could be agreeing to a fee increase of 200%. So it's not meaningful enough. You have to be more specific than that. Now, to those of you who may be using the AXA, NERA, Russell Kennedy templates, we have a default of CPI in there, but you can override that by putting something in your pricing schedule. So bear that in mind. If CPI is not going to work for you, you can be more flexible by putting something in your pricing schedule. The other way you can deal with this, if you've got a clause that doesn't quite work for you at the moment, is to go back and renegotiate. You can get consent retrospectively if you put your prices up, say 6 months ago, and you've sort of thought, oh, did I really get consent? There is that ability to get retrospective consent. And the other way that I haven't seen anyone try, but I think is a very legitimate way, is to actually sign clients up for a 1-year term. So in other words, you offer them an agreement for a year. At the end of that year, the agreement expires, you offer them a new agreement with your new pricing. I don't think the Commission will particularly like this because they will see it as inconsistent with security of tenure. However, the legislation makes it very clear you can have a limited term agreement with a client for home care. So there's not much I think the Commission could really do if that's the strategy you wanted to take. All right, so that is everything we've got on the fee adjustments, but I'll just now move on to my final topic, which is talking about home care expenditure and what are the rules and limits of that. And there'll be plenty of time for questions later on, so I'll be happy to take any more questions about the other two issues then. So there is a renewed focus, I think, by the Commission on how providers are allowing funds to be used, and this is quite recent. 3-4 years ago, the Commission was very pro-consumer choice, I would say. It was then the Complaints Commission, and very much supported consumers making decisions on how they would spend their package funds. However, very much, although nothing has changed in the legislation, the interpretation has very much tightened up by the Commission and the Department. You're all aware of the 2020 manual that's recently been updated. And if you haven't looked at the 2021 version, it's worth doing that because they actually have a fair bit of guidance in there about what the rules are. However, it's not definitive. So I'll just make that point. According to the manual, and this is the point that's worth taking note of, the Commission, if you get this wrong, the Commission will direct you to refund the service charges if the provider allows the consumer to to use their package funds for item services that are not allowed. And unfortunately, you can't then go back and recoup it from the customer. So I have actually seen the Commission exercise these powers. So you do very much want to pay attention to that. And that's why it's really important, I think, that if a consumer wants to spend money on something you're not comfortable with, that you say no. So in terms of the rules, you're all probably aware of the things that are clearly allowed under the system. So, you know, all the things that are in the common services, for example, nursing and personal care and physio and the like. So you can include those things that are clearly allowed under the legislation. You cannot include excluded items, and I'll talk a little bit more about this later. And you can include things that aren't on either list if they're required to support the care recipient to live at home. And that's the critical words there, those required to support the care recipient to live at home. And also it has to also be in the care plan, etc. So if an item's allowed, you still need to prove that it's in the client's care plan. In terms of excluded items, these are the categories. So as a source of general income, and I'll talk about really what that means, and that's where I'm going to talk about this everyday items issue. Food, we all know now that you can use it for the preparation, but the consumer has to pay for the ingredients, so they need to be making a contribution. Rent, mortgage, all fairly straightforward. Home care fees, so you can't use it to pay the income tested fees or other care funded by the Australian government. Probably the most common one I see there is people who want to use home care fees to pay for respite care in residential care. That would definitely be excluded by that category, in my opinion. Then we've got MBS or PBS funded items, again, fairly straightforward. Home modifications that are not related to the care recipient's needs. Entertainment, such as club memberships and tickets to events. And that one could be a little bit tricky to distinguish from things that are about promoting the client's social well-being. And finally, gambling, that's a fairly obvious one. So again, as I said, if it's not on the excluded list and it's not on the allowed list, this is the test you have to apply. And what I'd say is, if you've got doubts about whether something is required, I'd be always trying to get an assessment by an appropriately qualified health professional to evidence that it is. In a sense, you're outsourcing that judgment, but I do think that having a reputable health professional attest to a client needing that is going to be really good evidence for you if you ever had to have a dispute about that. So as I said, you can't use it as a source of general income. And really what that means is do not use home care funds as to purchase everyday items. So when I'm talking about everyday items, I'm thinking about things that you and I might have in our homes, as opposed to someone who is buying something because they're frail and aged. So really you want to be looking for, is there a clinical need for the item? If the answer to that is yes, then it's more likely to be allowed. And is this something that the average person, not just a home care consumer, has in their home? So if we're talking toothpaste, I think that that's something that you shouldn't be using it, because that really is something that everyone has. It's not specific to someone who's frail and aged. But there's probably the three big examples are things like petrol, phone and internet bills, and also using it for vouchers at something like a supermarket where they could go and spend it on anything they want. Those three things are all going to be problematic. With the voucher, you might be okay, but you need to make sure they're only spending it on the things that are required by their care plan. So when you are funding everyday items, you need to keep receipts and you need to show that it is required to support the care recipient at home and show that it has a clinical basis. At the end of the day, it is your responsibility to ensure that the funds are only spent on things the legislation allows. And if you don't have receipts to prove that the client spent their supermarket voucher only on continence aids, for example, then the government will say, well, that's on you and you have to now refund the package. Home modifications. So the point I will just make there, and I'm conscious of time, but really is that the things that the legislation clearly allows when it comes to home modifications are actually quite narrow. So these are the examples they give. And interestingly, this one about functional safety and provide an adequate level of security, the most recent manual has a new edition which says that you can't use it to pay for a security system. which I thought was a little bit potentially inconsistent with that. But what we can see there is the regulators taking that quite tight interpretation of what's allowed. And you can see here that it talks about you can assist the care recipient and homeowner to access technical advice on major home modifications. Yet it doesn't talk about using the package funds to actually pay for major home modifications. So I do think those words are quite important. And we know that this one is not allowed, things that are not related to the care recipient's needs. So I would just say home modifications are quite risky for you guys because of the risk of defects. If things go wrong, the consumer's primary recourse is to come after you. And that might be 5 years down the track. If maybe the daughter living in the house and some defects arisen with the work, you're not even, the client's since passed on or maybe gone to residential care. So they're not even your client anymore. I do also think it's difficult because home care providers, we're not builders. So you guys overseeing the quality of work, that's going to be a tricky thing. And at the end of the day, you are responsible for all the services that you allow a consumer to purchase with their package. So that's some things to think about when it comes to home modifications. And you do want to think about your contracts. For example, we use a tripartite agreement where the consumer agrees that if there are issues that they will go after the builder as opposed to the home care provider. Not quite sure where the Commission will stand on those sorts of arrangements, but we think that's the best way of protecting the provider in this situation. And finally, just on expenditure, I'm just going to make this last point. I get questions about self-management and people saying, well, if the consumer chooses the builder or they choose their own care worker or they choose their own gardener, we don't have to worry about the quality. That is not correct. The basic rules, doesn't matter whether the consumer is self-managing their package or if they're getting reimbursed by you, you need to make sure that you still comply with all the basic things. Make sure the pricing is documented. Make sure the services your client receives are still of a suitable quality. And you need to maintain good records to demonstrate that the services were actually provided and that they met those quality standards. I think if you are doing reimbursements or self-management, make sure your agreement deals with that. For example, have a clause in your client agreement which says what clients need to do to get reimbursement, and make sure your staff your care coordinators or care managers don't promise things they can't, make promises they can't keep around reimbursements. The last thing you want to do, a client to do, is go and spend $10,000 getting their windows replaced and then find out that you're not going to reimburse them for that. That is all. And I think we'll hand over to Bruce now. Is that right, Susan? And then we'll have some time for questions later.
Yes, that's right. Thanks very much, Anita. We're now going to go to Bruce, who will come online very shortly. Yes, and we will have questions at the end of both presentations. Also, just to let you know that the presentation slides will be available on the event web page, so the page you came from when you clicked through to watch the session. And we are, of course, also recording the session, and the recording links will be sent out at the end of the event. And you'll be able to rewatch all that. But that was great. Thanks so much, Anita. Now I'd like to introduce you to Bruce Bailey, who is the Managing Director of Pride Living. And Bruce is going to talk about CPR for your home care operations under the new funding rules. CPR standing for cash flow, profit and return, three extremely important things. As the Founding Director of Pride Living, Bruce's focus and commitment is in working with aged care providers to find practical and commercial solutions that assist them remain sustainable, focused and financially viable in a complex environment. His expertise and passion are recognised nationally by providers, industry peaks and government. His work with the Aged Care Financing Authority as Client Director and as lead editor on both RSM's and Pride Living's 2016 and 2017 Aged Care Sustainability Reviews are highly regarded throughout the sector. He's a member of Chartered Accountants Australia and New Zealand, is a Chartered Tax Advisor through the Taxation Institute of Australia, a member of the Australian Institute of Company Directors and a registered company auditor. Welcome, Bruce. Thanks very much for being here with us today.
Thanks, Susan, and thanks everyone for coming online. I've decided not to share the screen with slides today, but there is a complete slide deck that I'll be talking to, and then I'll pass it across to Susan, and you're welcome to it. I just thought in terms of this visual context that seeing a series of slides scroll on the screen might not be the way you want to go through things. So what I'm talking about today is managing the financial impacts and the business impacts from the new home care funding model. And at one level, this is quite simple, and yet at another level, I think there's some more complexity in it. And what I want to talk to is three things. I'm just having a little technical difficulty here around, here we go. So I want to talk about the cash flow impact of the changes, both, I guess, the short term, but it's more the longer term impacts that I want to focus on here. I then want to talk about the cost of growth under the new home care funding rules, as opposed to the cost or benefit of growth under the old rules, and then some insights into sustainable home care business models, which, as Susan said, at Pride Living, we're very concerned and interested in sustainability and how you might be able to improve that within your operations. So 3 key areas, and we'll have a look at them. Some time ago, when I was talking to providers about what's happening in the sector at the moment, it struck me that the term CPR was quite a useful one. When someone's at death's door, we perform CPR on them and hopefully keep them alive until some help comes along, and then they can be more effectively restored to health. And I think that's pretty much, if you're in the aged care sector, that's where you are now. We're all waiting patiently for things to improve. And CPR worked well because within business, and for the accountants, I apologise for talking to things that you'll be familiar with, but to those who are not so financially literate, this might be helpful, that whilst ever you've got positive cash flow, you can stay in business. So it's a bit like while ever you're breathing, you'll still be alive. But at some stage, you have to make a profit. And if you don't make a profit, then the cash will actually run out. And so you need to move to that. And then ultimately, to be sustainable, you need to focus on what's the return that you're getting out of the activity that you're doing. So the financial return, lots of different ways to measure this. Commonly, you would measure what's my profit margin as percentage of profit to percentage of sales, or you might relate it to the value of assets that you've got engaged in the activity that you're doing. But there are measures that you need to deal with, and there are industry norms that tell you how you're going relative to others. So those things work. They're pretty tried and true from a business and commercial management perspective, and I think they're relevant at this time. So if we look at the cash flow impact of the changes to the system, what I've done here is the slide actually goes to some high level things, and it talks to that there's a cash conversion cycle in business, and that cycle is the difference between the days it takes you to collect money and the days it takes you to pay for your suppliers. And to give you an example, if you're running a major supermarket chain where you beat up on your suppliers and say they have to take 90 days of payment terms, and you sell everything on cash, then the faster your business grows, the more cash you actually have in the business. So they're great businesses to be in. If you go to the other end, where you're an importer and you've got to place orders maybe up to 6 months in advance, and you've got to pay for those goods, and then you have to give credit terms maybe to a Woolworths or a Coles, and give them 90 days, then the faster you grow causes you to consume more cash. So in the home care business, at a general level, we would say that you were able to get minus 30 days of credit terms from the government. That is, that they paid the money in advance. And so the faster you grew, in fact, the better off you were. And if you made a loss, well, you still had cash that was coming in. Under the new system, that's going to change, and you won't get those negative 30 days as I put it in the slide. Under your terms to your suppliers, they're likely to stay the same unless you decide, as a result of the changes to the system, that you want to start to manage the credit terms that you have. So, for example, you might currently be used to paying some of the outsourced gardening providers to your home care recipients. You might pay them, it's 7 days. Well, you might now want to consider, as we go through the numbers, whether you want to extend those payment terms. So you do have choices here, and there's options for you to calibrate the impact. So if we look at what the average provider, and the average provider doesn't exist, but it gives us a sense, and I've managed to reduce this down to a per client basis for you. We did some modelling, and we said, well, if you've got a provider today and they're getting a certain number of terms from their suppliers, they've got the money coming in advance. If you take away the advance money and then you take away the unspent money, what are the effects of that? So we started off by saying the average provider has about 148 clients. So in theory, about half of the people watching and listening at the moment have more than that, and about half have less than that, and very few will actually have 148 clients. According to the benchmarking surveys that Stuart Brown do, that translates to about $911,000 of unspent package money that you're holding across those 148 clients, and about $347,000 of subsidies in advance. Now, the calculation for subsidies in advance is based on that your group of packages are reflective of the percentage of levels 1, 2, 3, and 4 that are available in the system. And so if you want to know, well, what does that mean for everyone except the 148,000? At a general level, it suggests that you're holding $8,480 of government cash for every client that you have. Now, we've all seen the big macro numbers, and treasuries are full of very intelligent people, and they've just logically said there's all this money out there in the system. It's sitting in people's bank accounts. It's government money. If we got that money back, we could afford to fund more packages. And so, if you take $8,480 for every package you have, that hopefully you'll be able to relate that to, if you look at your financial statements, when you'll see the unspent money and the funds in advance on your balance sheet, you'll say, yep, that's reasonably what it is. Of course, there are differences in everyone's mix of packages. So the other way you can find out how it's working for you is to get how much of your unspent package money is and how much is the subsidies in advance, and simply divide that by the number of home care packages that you're servicing, and that'll give you a sense of how much it is for each person. So then, if we looked at what's going to happen now when the system changes, and again, these are guidance numbers, and you need to do the modelling directly for your particular situation to confirm them. But as a general statement, we think that going to arrears funding will absorb about $4,700 of cash per place. So when the government says, well, we're now going to pay you in arrears, and I know that there's a shading in provision, all that does is soften the impact of that. It's still coming at you at some stage in the future, 6 months down the track. The next impact is when we go to the acquittal funding process, where you get paid at the end of having spent the money. And we think that's going to have an impact of around $6,100 per place. So in combination, there's going to be an impact of about $10,800 per client. Now, the reason that's different from the cash you're holding is because you're not holding all the cash in advance. So it's just the way the numbers work out. Again, you won't be able to necessarily work that out in the same simple way that you do for what is the amount of cash that you've got in the system at the moment, because there's the impact of the days of credit that you're giving out to your suppliers that's added to this as well. But we can certainly get, on a per place basis, a clear understanding of what's going to be the impact, And then if we know what the impact is, we can start to look at what's going to be the future impact. And I'd suggest that if you're uncertain about how this is going to affect your cash position, then it's just a matter of getting some simple numbers. You don't need to go through any complex modelling to get this. Get the high level numbers and they'll give you a real sense of what's going to go on. It's going to take time to come through, and that's great because that gives you time to work out how you're going to face the impact of that. Now, it might be that you're holding all of those funds in cash, but we've seen a number of providers where that's not really the case. So you've got this liability to acquit, but some of that cash has actually been used for other purposes. And if you go back to my CPR example, I said, provided the cash flow is positive, you can keep going. So you might have been losing money in your home care business operations, but you were still getting all of this positive cash coming in. And so the cash has actually covered losses that are somewhere else. Now that's going to stop being the case. And we did see a case, in one case, where a provider was wanting to sell their business. They had the balance sheet, they'd put in there a figure for goodwill, which is not cash, it's great for accountants, but they had a huge liability for funds in advance that they were holding and unspent money. And it actually, for that transaction to proceed, the seller was going to have to put in a very significant amount of money because the cash had actually been spent somewhere else. So there are going to be some real dislocations coming to some providers where they haven't managed their cash position well. Hopefully that's the minority, but certainly in these times when lots of providers are struggling, your cash can be going out of the system, and unless you really focus on cash flow and where it's happening and why it's happening, you can be left wanting in the future. So that's really what's going to happen to you in the constant present state of where you are. I think the other issue is becoming, what's it going to mean as you try and participate in the growth that's happening in the sector? So we've all heard about the announced extra places from the government, and I'll share with you some deeper insight into that in a minute. But overall, we know that progressively the system is going to have more people receiving care, and therefore, if you're going to stay relevant in the industry, you should be growing at about the rate that places are growing over time. Now, in our modelling, now that we've caught up on the backlog, it's going to be about 3 or 4% per annum. And so if your client number's not growing at that pace, then you're becoming a smaller player in the sector. Now, that might be okay. You might be happy with that. Some people want to say, well, I want my position relative to other players in the sector to remain the same. So if you're growing, what we know is that every additional place used to generate $10,800 of cash flow. We talked about that just a little while ago. And that was great. You know, you got the money in advance, and then over a few months, you also picked up the unspent portion of the funds. So growth was cash flow positive. In the new model, according to our modelling, if you are in loss, then your cash flow will be negative by 106% of the amount of your loss, not 106% of the cash that comes in of the loss. So if, for example, your business was made up of one package, and it was the average package of a bit over $20,000, and you lost $10,000 in delivering that service, then we would expect that your cash loss would be $10,600. And if you're profitable, then the cash flow will be about 94% of the EBITDA that you're generating from your operations. So what that means, and this is a fortunate thing for the sector. So once you get over the initial shock, going forward, what's the impact going to be on your operations of having an in arrears funding regime as opposed to the in advance funding regime? What we can say is that your cash flow will fairly closely approximate the EBITDA you generate. So if you're operating for zero, at a zero outcome, then
you'll get zero cash. Now that will mean you won't have any money available to pay for capital items. So it then becomes, how much money do you need to generate the cash you need to replace the equipment and the other activities that you need to do? And of course, there's a lag time in all operations commercially that you need to invest first and generate cash second. So, but I think with these numbers, you can have a sense of, well, what's it going to be to me? Just multiply the individual numbers out by the size of your packages that you're servicing at the time and by the number of packages you wish to service into the future. Again, I would be saying you want to get some quick models that are based on percentages and numbers, and then you can get a really good overview of what's happening without having to go to these detailed models of what's happening each month and paying out this money and paying out that money. I just don't think that's necessary for you. I want to now move to sort of the models that are working, and this really picks up a bit on what Anita was talking about. So I've called this about the consumer perspective. And so having if you like, a sustainable home care business operation, commercial operation, is all about understanding and meeting consumer expectations. We get that, but what does that mean? And so what I've got here is some details around what do we know from the research that's happened. And I would encourage everyone who's interested in these sorts of things to look at research papers 14 and 20 from the Royal Commission. They give great insights into the consumer perspective. They cover both resi and home care, but the section we're interested in is home care. So what we know from these sources is that only 50% of care recipients feel their needs are mostly met. And Anita was talking about the number of complaints and the number of complaints around money. And we know that that's the complaints in finance and administration is the highest level of complaints that people have. That's at 45%. Complaints about the staff who are delivering services is 33%. The lack of choice, and Anita touched on this, people want to say, well, I want to use my provider, not your provider, 27%. And then the services quality is about 20%. So there's a lot of unhappy consumers out there. And what happens when people are unhappy, they ultimately go to how much they're paying, because they say, I paid this amount of money, I didn't get what I wanted, it's not worth what I've paid for it. They're not actually complaining about the price, they're complaining about the value. And this is one of the things that I think is particularly challenging in the system, is that government is trying to make this all about price, when we as consumers mostly operate on, have we got the quality that we expected? And if the quality is, if you want a basic meal, you might go to McDonald's and say, well, I'm happy with that because of what it is. Or you might go to a 5-star restaurant because you say, well, I want a different type of meal. Now, they're both very different prices, but if you get what you're expecting, you're happy with both prices. So people saying that price is the problem are actually missing the issue in here. There's another interesting statistic that I found in these reports, that 70% of complaints about the operations are actually given to the staff. So you can find out what's happening if your staff feel safe in telling you about the shortcomings in your service. A third of complaints are shared with family and friends. There's an overlap in here because people talk to more than one source. And the other thing is, only 50% of the complaints are actually resolved to the satisfaction of the customer. And so they continue to have this lingering issue about the value of what I'm getting. And then that's when it ultimately ends up as complaining through to the commission. So complaints, I think we've all come to understand complaints are a good thing. Allowing customers to have feedback is the way that you find out about complaints, and allowing them to feel safe is the way that you get value out of that. So I found those as very interesting, that most of the issues are not getting reported into the commission. So if you're looking only at that and saying, oh, things are going well, no, they're not. There's a lot of other hidden stuff out there that you perhaps should be looking at. There's a slide in here that provides a lot of detail about the particular things that concern people. And the one at the top is value for money. And then it says, e.g., fees are too high. So that's the biggest concern for all consumers. But again, it's not the fee itself, it's the fee doesn't meet my value expectation. I actually think that we should be charging a lot more for package management fees, because that's the, if you like, the high level service. People have a sense, well, if I'm paying a gardener, unless they do a particularly good job, then there's a standard rate of cost for that. So if people are seeing that there's a disconnect between value and cost, then what do we know about what people value? Again, well put out in those research papers I mentioned earlier, and no surprise, we expect to be treated with dignity and respect, expect skilled staff, services that assist health and well-being, and being supported to make their own decisions. Well, that actually wasn't so important with people. And I can understand this. My mother's on a level 4 package, and for her, she really doesn't know a lot of the decisions that she can make because she's never been in this position before. So she's looking for help, which goes to the third point, which was services that assist her well-being, and certainly being treated with dignity and respect. Well, that's just a given for everyone. You'll see in those reports, there's a value for getting adequate services, and there's a value of getting high quality services. And so they're very interesting to work through. Looking a bit more to the future, what we know is the average revenue from a client is $540 a week, $28,000 a year. The average life is 1.4 years, and the profit varies between $1,500 and $5,400 per annum. And there's a long-term growth in packages of 3%. So that gives sort of business models a way of saying, well, what's this going to look like as I go forward? If I get some growth, how's it all going to work? What's interesting, and this table came out in, I think it's in the December report, which is the September home care packages report. And it shows the number of allocated home care packages across the forward estimates. It's really interesting. The government makes the announcement about we're putting all these extra places into the system. What's been happening for the last 3 or 4 years, whenever that announcement's been made, what they're doing is they're accelerating the rate at which the packages that were committed in the future are coming into the system. So there's a table in the slides that show in 2020-21, 195,597 packages out there. So the government is saying, well, there's 200,000 packages out there, but the government's forward estimates have that number remaining constant to 2024. Now, if that is the case, it means that your only way to get growth is actually to get customers away from another provider. Now, the customers are turning over all the time, and so you get a new one for one that you replace, but to get 2 for one that you replace means that it has to come from somewhere else. And that's difficult because we know that there's the national pool, and there's presumably some geographic equity in that. So the number of places in your SA3 can be expected to remain relatively constant. And so it comes down to making sure that people know who you are and can find you, which is one of the interesting things. So some observations on this whole future growth. The future growth in places looks constrained. That suggests to me that the competition between providers is likely to intensify as people are wanting to make sure that they're not losing the aggregate number of places they're providing. And really, to replace clients requires what we call an opportunity management system. So everyone gets inquiries, and recently I've had with my mother, who's going to be moving into residential care soon. My wife and I have been doing the work on that. We spoke with 5 providers, and one provider took 3 weeks just to get back to us to say, would you like a tour? Now, they clearly don't have a very good opportunity management system, because if I'm looking for something, then I've moved a long way in 3 weeks. And I would say that there's 4 key attributes of this opportunity management system: is creating awareness for people, because people are at all different stages of the journey of making a decision. It's correctly identifying opportunities. And again, my experience was, unless we could give our access code, then people wouldn't think that we were really serious, which made me think doing mystery shopping in this sector is very difficult, because if you don't have the codes, then you don't really get to understand the detail of what someone's offering. And it's the same with a home care package. If someone is, unless they give you details of their package, if you don't take them seriously, then how can they know what you have on offer? Maybe there's an issue about taking people a bit more and taking them through the process. You've got to manage the opportunities through the 5 stages of purchase. Now, I was just doing a bit of research around this, and I thought, this might be a helpful thing for people, that we've got lots of care-oriented people, lots of process-oriented people, but do people understand the 5 stages of a purchase or a decision process for someone looking for someone to provide them their home care services? And then what you need is a service offering that meets the client's needs and expectations, which goes back to the point I raised earlier about the things that people expect and about the things that disappoint people. So there's a whole bunch of things that you need to do. Just to finish off, how important is cost? I've talked before about cost and value. I've got a slide in here about how much cost and value matter. There's research that shows that people are prepared to pay, but they're only prepared to pay for something that's of value to them. And then there's a slide in here which talks in a bit more detail about these 5 stages of the purchase cycle, which will help you out in talking to people. And I think with that, there's a few parting suggestions, but what I'd end with is test things fast, fail fast, and adjust fast. And it doesn't come from me, it comes from Tom Peters. So with that, Susan, I'll hand back to you.
So much, Bruce. We do have a couple of questions that have come in, and I know Anita has been busy in the background answering some of the questions that have come in around pricing that were very sort of specific to the providers asking them. So those have been answered with written answers. So if you'd like to have a look at those, you're welcome to. But thanks, Anita, for doing that. But just for you, Bruce, Ken is asking if you can clarify just around if the department will be paying the funds in arrears or in advance with an adjustment at the end of the month, and when that will be swapping over.
Yeah, I didn't quite understand the way they've expressed it. They've said you have the option to progressively adjust down from the advanced payment you're having now, but they didn't say if you don't choose that, we're going to take it all at once. So there's a shading in period over which the advance payment will progressively be unwound. And that runs till September. So it's going to give you time to adjust.
Yes, but definitely by September 2021, all payments will be in arrears. Yeah. That's what we're moving towards. And would you be able to, another question, whether you'd be able to make any comment on if you feel the number of providers in home care, and we were discussing this a little bit before the session actually, are increasing or decreasing? So are we seeing more providers entering the market or more providers exiting the market, and why?
I've been tracking for about 2.5 years now the change in each of the quarterly home care packages reports that come out from the department. I did it first to find out just what it was telling me. And I found out that the government's model says that it's about 4%. 4% is what they say the demand is for over 70. And we've calculated that the real demand is over 7%, which tells me there will always be a huge unmet demand, because government might have advanced the number of places, but they haven't increased the aggregate number of places beyond their percentage. So that's the first thing. in terms, they publish in that report every quarter the number of providers. And I think it was 969 is the last number I saw, or that might have been the number before. But when I was putting these slides together, I was updating the December report, which is September last year, so the latest report. And I noticed that there was very little change in the numbers. It might have been 2 or 3. So the numbers seem to have stabilised. Possibly that's because it takes so long to get an approval from what we've seen in providers going through it. And mind you, some providers are approved for both, and I'm not sure whether that's within the statistics that they've got. So I'll caveat, I don't really have good understanding of the definition of providers in the report, but it looks fairly stable. It hasn't been growing hugely in the last 12 months.
Thanks, Bruce. And there's we have come to 5 p.m, but we just have a couple of questions. So I understand if people are needing to go, but we might just go for an extra couple of minutes just so we can finish off. And are there any indications on how item purchases will be processed when providers are required to invoice for services? That's, for example, like a contractor installing handrails or a shower needing to be installed.
No, I haven't got any detail on that. Anita and I were talking about this earlier. I think the challenge for government is a desire to see appropriate acquittal as against timeliness of payment. And so the more they want to go into the detail, the longer it's going to take them to make the payment. So I'm not sure what they do. They might bring in an auditing process that means that you pay it, you think you're okay, and then 6 or 12 months down the track, you have to repay that money. As Anita says, the risk is with the provider.
Yes, I think there is a bit more detail to come over coming months about the exact processes for the payment and arrears from the department.
If I may, I think the bigger risk is the government now has so much data around what people are paying for what services. And this is the age of big data. It'll go in and you'll be saying, provider A will be paying X dollars for care workers, Y dollars for this and so forth. I would see the big risk here is that we move to a position like the NDIS where government says we will pay you X dollars per hour for this type of service. And then it becomes a very challenging model to work in. People have heard me speak before. Governments are not in the business to make people running operations wealthy. They're in the business to make sure services get to end consumers. And in their approach to that, it's always about if we pay less to everyone, then we can pay it out to more people. And that works both from a departmental perspective and it works from a, if you like, a political level. So I still encourage people to look to the untapped market and other services that you can provide. And the evidence is that people will pay.
Thanks very much, Bruce. Look, we have gone a little bit over time and unfortunately we've run out of time to do any further questions, but we are taking a note of those and we will pass them across to Bruce and Anita so that they can answer those through to you. So Anita is back here and thank you very much, Anita, for doing some lightning quick typing of answers to the many questions that came in from providers, very specific questions. So I think that was great that you were able to answer those, specifically for them. I'd like to thank you both so much for your time today. It's been a great session and we've had lots of people watching in. Just a reminder that, the slides and resources will be on the web page that you came to click through to watch the session, our delegate web page, and also the recording of the session will be sent out after the end of the symposium. So I'll say good evening or good afternoon to our friends over in the West and enjoy the rest of your day and thanks very much.
Okay. Ciao.
Thank you all.
Yeah. Susan, do you want to